The global recovery continues, but it is a weak recovery, indeed a bit weaker than we forecast last April. If you look around the world, in the Eurozone, growth is close to zero, reflecting positive but low growth in the core countries and negative growth in the periphery countries. In the United States, growth is positive, but too low to make a serious dent to unemployment. And growth has also slowed in major emerging economies from China to India to Brazil, and maybe most importantly, downside risks coming primarily from Europe have increased. Now, the main risk is obvious. It is that the vicious cycles in Spain and Italy become stronger, that output falls even more than it does, that one of its countries loses financial access to markets. And the implications of such an event could easily derail the world recovery.
It's clear that given the size of the US economy, what happens in the US has large spillovers for other economies.
So suppose it were 5%, which is what would happen if we fell down the whole fiscal cliff. That would be 2.5% more, right? I think it's reasonable at this point to assume that multipliers are of the order of 1.5, which means that, other things equal, this would take 4% of growth next year for the US. And then, as back of the envelope number, assume that the effect on advanced economies would be 1/3 of that. And so this would be a decrease in growth relative to our baseline of 1.5% for advanced economies as a whole. We're talking about potentially an enormous shock. And therefore, yes, if it were to happen, this would be a major event.